Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review. I'm recording this mid-Friday morning, December 27th. This is our last video of the year, of course, so I wish you and yours a very happy, healthy, and prosperous new year and entire 2025, okay? So it's been a very good year. I've been around a little while. Usually every 3 to 4 years about is when you're going to get an environment where leading stocks can really let loose on the upside. And that was certainly this year, especially the second half of this year. So hopefully you grabbed a couple winners, which is really all it takes to make a big difference in your portfolio. And if you didn't, obviously just learn from some mistakes. And even if you did well, learn from whatever mistakes you did make. Stepping back, it's been a great year, but right now we are kind of heading into 2025 in a cautious stance. We're about half in cash in Cabot Growth Investors model portfolio. That's not necessarily a broad market call, but it's based on the entire environment, which includes obviously a good year and a nice second half of the year. But a lot of things got extended price-wise and time-wise. Sentiment, short-term sentiment got very, very elevated. We're still seeing a lot of speculative names, kind of pop and be in favor, that sort of thing. And then we hit December and three things happened. Number one, leading stocks got hit. Some of them broke, intermediate term I'm talking about. Some of them flashed abnormal action, but I would say almost all of them, not all, but almost all had what I would call shots across the bow, which was like, okay, this is not just a pullback. It's a little bit outsized. This could be a change in character. Number one. Number two, we saw the broad market really get hit persistently. Like the entire first half of December was basically negative breath, and there's a variety of ways to measure that. And number three, the intermediate term trend, our Cabot Tides, our intermediate term trend model turned negative, mainly because of those broader indexes, small caps, mid caps. We'll take a look at that. Because of that, we had been paring back with the leaders. We sold some things outright. And like I said, we're about half in cash. Right now, I'm cautious, but I'm very flexible. I'm open to this being sort of some churny, today as I record this, it's a bad day, but some churny, frustrating sort of corrective activity for a month or 5 weeks. And then we get going again, have another leg up, and there's some fresh leadership to buy. I'm not having trouble building a watch list. Cabot Top 10 Trader, the last couple of weeks has been very growthy, which I think is encouraging. It's not like big investors are, running for defensive stocks and stuff like that. At the same time, it wouldn't surprise me if, we had sort of one or two selling waves in December and we need another one or two going into January with some of these stocks that are up, 200-300% in the last 6 months. Okay. So right now I'm favoring staying a little bit closer to shore, holding some cash, holding some, I would say, modest sized positions and, winners that we have that we've already taken partial profits in, and just taking our cues from the market going forward. Okay. All right, let's hop on the charts, show you what I'm talking about. As usual, I'm using a program called Market Surge. You can learn more at marketsurge.com. It's a product of Investors Business Daily. When we start with the major indexes here, it's a tale of two markets. It's a little bit like we saw in June and July. Here's the NASDAQ composite. Again, it's getting hit today, but even today, after being down, it was down 400 points when I started this video. It's at the green line, which is the 25-day simple moving average. So it's not a big thing, and you can just step back. It's certainly still in an uptrend, okay? Maybe the 20,000 level is sort of round number resistance or whatever, but either way, the trend is still up. S&P 500, not quite as good, but not bad. Today, it's down to about the 50-day moving average. So intermediate term trend positive. When you look at pretty much anything else, though, in terms of indexes, it's either kind of neutral to negative, okay? So this is the mid caps, clear, decisive, break of the 50-day line, and really no, this was sort of the Santa Claus rally to this point. Not that much of a bounce, right? Small caps, this is the Russell 2000, almost the exact same picture, break of the 50-day line, very little bounce. New York Stock Exchange Composite, same picture. This is the RSP, which is the equal weight S&P 500. I mean, again, they all look kind of the same except for the big cap indexes, right? The QQQE, which is the equal weight NASDAQ 100, not quite as buried sort of below the moving averages, but still well below, clearly below the 50-day moving average, okay? And even the growth stuff, the growth indexes, of course, they're down today. This is the IBD 50 index, so maybe it's down here somewhere. So call it neutral if you want, but it's not, I wouldn't say it's positive. It hasn't gone anywhere in a few weeks. Down to the 50-day line. This is the IBD 85 index, which is a little bit higher quality. I shouldn't say higher quality, but just more well-situated firms, I guess is what I would say. So it's probably down here somewhere today, but again, below the 50-day line. So pretty much everything besides the big cap index is in an intermediate term correction, downtrend, sideways phase, whatever you want to say it, but it's not really continuing in an uptrend, okay? Secondary evidence too, sorry about that. Secondary evidence too, this is the 10-year note. I had mentioned before above 4.5 maybe would be an issue. We're not, cracking here, broadly with everything as we look at it, but it's getting pretty close. We're above 4.5%. We've seen a lot of indexes crack, the broad market crack. We'll see if the big cap indexes can do it. But it's threatening, it's testing sort of multi-month highs, obviously, on that front, okay? The other, I would say on a positive front, just to run through some things, well, this is what I wanted to mention first. We look at the small caps, we look at the mid caps, and it's kind of like, it's very kind of generic, But you just look at, like, this is transports. And there's a lot of transports. I mean, airlines look great. But this is the IYT. This is the Dow Transports. I mean, that's kind of what we saw in the first half of the month. We saw a little bit of a bottom last Thursday, I want to say it was, about a week ago before Christmas. And it's just been, it can't even really get off its knees, This is the, industrials. It looks a lot like that. So there's just a lot of sectors and stocks that look like this that have broken the intermediate term. I'm not saying that means they're going down here, but after, a pretty, even for the stuff that wasn't super, super hot, the industrials had a nice run here, pull back, nice run, pull back, nice run higher and higher. That trend has cracked, so we'll have to see it find support first. I just think the onus is a little bit on the bulls here, right? I would say on the, I don't want to say positive, but the not negative side. So this is the XLP, which is consumer staples, my favorite defensive measure. It's not like there's been this rush out of the NASDAQ. If anything, the big cap NASDAQ is still resilient, but it's not like there's been this rush out of growth, which there has been a little bit, and into defense. It's just been kind of a rush out of everything. Now, I'm not trying to make that sound, it's not a good thing per se, but to me, it's better than, clearly where they're running into the XLP and stuff like that. This is POWA, which is sort of a thinner fund, but they invest in a lot of kind of consistent growers, very, slow, steady growers sort of thing. So it's been doing well, but you can see relative to the market, the peak was back in August. So it underperforms in good markets. But even here, it's really slid and broken the 50-day line. So it's been more of a, except for the big cap index, it's been kind of a very broad selling action for the first half of December, and we'll have to see if that continues. Like I said, that's the bigger reason why I think it's better to stay a little bit close to shore here and just see how it goes. I think if we get going, it's not like you need to pick the exact bottom. We can wait 3-4 days to see if there's some stocks that are breaking out, some new leaders emerging, the intermediate term trend turns back up, that sort of thing, before really starting a, relatively major buying spree, okay? Now, the good news, as I sort of mentioned in the intro, is it's not hard to find stocks that are holding up well and acting relatively normally. Maybe they're jumping all over the place, and on a day-to-day basis, oh my God, it's down 5%. Oh, it's up 6%. But when you look at a chart, it's kind of relatively well contained, okay? GE Vernova is one of the spinoffs from GE. This is GEV. Now, after this run, this is the weekly chart. It broke out, actually, I think it broke out in August. It was one of the first to break out. And then it was up a bunch of weeks in a row. And it's just been straight sideways since. I'm pretty sure I mentioned this recently. But, maybe this is a top. Maybe 350 is the top and the stock breaks down. So right now we're just watching it. But, it is sort of, given that it's holding up with the damage in the broad market, with the damage among some growth stocks, I think it looks pretty attractive here. But we'll see how it goes. It definitely needs to, find its footing and get going, and the market does too. But so far, so good, okay? Rubric, RBRK, this is more of a glamour name. And again, so a lot of these things, so I'm going to mention, I'll mention A-Lab here. This isn't really, it's not really buyable. I mean, it's still sticking straight up in the air. But I will say that when something is straight up in the air like it was back here, it's like, well, let's see if it pulls back. And I'm still thinking that. But now that the market has had a bunch of selling, now that we're getting hit today, we got hit, the broad market got hit in the first half of the month. Leaders got hit in the first half of the month. And this hasn't, you start to see names like that are still kind of, this is a little bit too extended for me right here, but they're still extended, but the relative strength is noteworthy. That's kind of what I'm thinking with Rubric, which, broke out. It depends how you want to define it, but, say it broke out back here somewhere near 40. It almost doubled. It went wild on earnings. And it's pulled, don't get me wrong, it's pulled back from 76 to 64. That's not fun. But in the big scheme of things, it looks fine. Even today it looks okay. and it's just kind of hanging in there. You know, the weekly charts take some of that noise out, and you can just see it's just kind of hanging out in this range here the last 3 weeks. So, you know, that's definitely one on my watch list. It certainly, again, has the potential to get hit if the market does, but so far, so good. Kendrill Holdings, this was an old tech arm of IBM. It's not a super fast grower, but it's sort of a margin play. You can kind of see it's had a nice run here, but it built this sort of nice consolidation here and then really changed character a couple of months ago, and really has just spent the last 3 or 4 weeks just consolidating here into the 25-day moving average. Again, it's still kind of extended, so this is why I kind of want to wait. You don't know if some of these things are going to be down here in a few days, but so far, so good. I keep saying that, but so far there's a lot of stocks that are just kind of gyrating, but not really giving up the ghost. And if they're gyrating again when the market's going straight up and everything's going straight up, that's a little bit relative weakness. But in this environment, I take it as a good thing. Okay, Google. I just wanted to mention Google. It's not my cup of tea. It's a little bit, I don't want to say speculative in the sense of the quantum computing chip, which kind of got going back here. But there has been a lot of buying. This was a little bit options related, but there's been some really, really big volume buying days. And again, taking out sort of the daily noise, it's just been kind of, after a nice run, it's just been kind of hacking around in a range. Okay, again, maybe 200 is round number resistance. Maybe the stock falls and the market gets nailed in the first quarter. Like, who knows? But so far, I do like the action. TGTX is interesting. This is TG Therapeutics. It's kind of smaller, a little thinner. I don't say thinner. It trades enough, but you can see it hacks around quite a bit. You can see it got mauled a couple of years ago. It's kind of come back here on the weekly chart. The last year, though, well, maybe 9 months, it's been acting more properly. Still volatile, but more proper. And just recently, you can just see there's really been no, real consistent selling. It's been a little churning here and there, but on the weekly chart, not much. And so far, it's kind of built this almost like a base here, kind of like GEV. I mean, it's different, but it's kind of built this base for the last 6 or 7 weeks in here above the 50-day line. So we'll see how that goes. Chip stocks are still, I've mentioned this before, chips are still, this is the SMH. They topped here in June, July. They kind of had these sub tops here, and they keep toying with the 200-day line. Like, do we come in next year when the calendar flips and it's bad news? It's possible. But they keep putting up a fight here at the 200-day line repeatedly. So I'm still trying to give it the benefit of the doubt. And there are some chip stocks that are looking okay. Taiwan Semi is interesting to me because number one, it wasn't one of the ones that got going. It got going at the beginning of this year. So it's not like early stage, but it wasn't one of the ones that really got going in like May of 2023. So it's a little bit, I don't want to say fresh, but fresher. Number one. Number two, it's basically spent the second half of this year just building kind of a base on a base, okay, which is nothing, there's nothing magic about it. It just kind of had a deep correction and came all the way back to hit a new high, unlike most of the group. And then it spent the last, 2 or 3 months, whatever it is, in here, 2 or 3 months in here, just kind of consolidating in a 10-15% range. We'll see how it goes, but obviously if the market, chip stocks kick into gear, breakout, however you want to play it or not, I just think it's a decent setup, okay? Just a few more here. Dutch Brothers. Restaurants have been, to me, Cava, which we owned, it was a nice winner for us. Cava was kind of the number one stock in the group, and it had a huge run, and it's in my opinion, topped for now. Not that it's topped permanently, but it's certainly not acting right. So that makes me a little wary on the group when the number one stock kind of gets nailed and breaks down. I have to say, though, Dutch Brothers is a name we've watched for a while, BROS. I've mentioned on the video a million times. And I think like after just years of just hacking around, really, just impossible to play unless you're a trader, it looks like it's changed character. Not only does it gap up, but now just look at this action. And this is happening while everything's so hectic out there, with the growth stocks and everything. So it certainly looks like it's changed character. We'll see what everything looks like when the calendar flips, but so far so good, just to keep using that phrase. Birkenstock. My daughter was helping the stock this Christmas season. But it got nailed on earnings here, relatively new issue. But obviously kind of one of those retail themes that could trend. Obviously it's sort of already popular, but has a lot of room to grow. And I don't want to say it's changed character, but you did have some accelerating buying here on the weekly chart, and then obviously reacted well to earnings, as you can see right here. It churned, but, it was one of those days in the market. So it gapped up, churned, but again, it's held in there pretty tight. So it's just building a nice structure. Maybe it needs some more time. Maybe it needs a few weeks, but overall looks pretty good to me. And just a couple more here. Toast. Toast had these three, this was almost one of the first clues. It had these three big volume skyscrapers to break out, which you would normally say, hey, the first pullback from that would be buyable. I mean, nothing works 100% of the time, but odds strongly favor. Then it gets hit on a conference. Their margin outlook was not that great. It really kind of abnormal here in the short to intermediate term. But it has come down to the 50-day line and held, and it's just one of these names I'm sort of keeping a distant eye on. Maybe if it resumes, I'm not going to give you a specific level, but if it resumes higher, with growth stocks pick up speed, and this can kind of get up and going from here, that would be kind of interesting. And the last I'm going to mention, Geo Group. This is sort of politics. I don't get into the politics. If you don't want to buy it, don't buy it. But it's kind of a deportation play. My job is to bring ideas and to make money for subscribers here. Geo Group is it's a private prison operator. They work with ICE and different things like that. And people are anticipating business is going to pick up. It is speculative, not speculative. It's a real company, but this move is speculative. I would say the move was only 3 weeks long, and it's held very well, which is very, very nice pattern. Usually you'd like to see it a little bit more persistent on the upside, not just 5 or 6, this was all kind of within 5 or 6 days really of upside. But so far the overall pattern's interesting, and the longer this thing can hold up and some of these names can hold up like that, the better the chance that they can resolve to the upside. Okay. Back to the market as a whole though, we'll see how it goes. I want to give, from an overall perspective, I'm sort of giving the bull market the benefit of the doubt. I'm not making some market call saying, the broad market, did this and that means this. I'm just saying that when you look at the evidence as it is today, there's not a lot of stocks that are working. As of at the low last week, it was like 20% of S&P 500 stocks were above their 50-day lines, and that was one of the stronger areas of the market. So there was a lot of stuff, 2/3, 3/4 of the market was below 50-day lines. Leaders that had huge runs clearly were coming under pressure, which makes sense at some point. You're going to have corrections, So let's just see how it plays out. Like I said before, I could see this being sort of wave one. Now maybe we're having a second little, when I say wave, like a reverberation, a tremor, an aftershock, whatever you want to call it, of selling here. Maybe there's another one or two in January, I don't know. But I could see things gyrating and get frustrating, and sentiment comes down and some bad news comes out in the world, and then we get going again. So I'm very open to that possibility. But like I said at the beginning, I just kind of, as we roll into 2025, it's been a good year. I just kind of want to see the buyers and the institutions step up, especially into some of these key leading stocks first, at least for a few days, and try to turn the intermediate term trend back up before putting a huge chunk of money back to work. Okay, that's all the time I have for today and for this year. Again, have an awesome New Year's, and we'll be back again next Friday, January 3rd, I think, for your next Cabot Weekly Review.